There's a surge of attention around silver accelerating, gold holding firm, and the broader question of whether this is just another short-lived spike or the early phase of something more structural. At first glance, the narrative seems simple. Metals are rising because fear, debt, and uncertainty are rising. But when you slow down and examine the details, the story becomes more layered. A major issue right now is how quickly speculation turns into certainty. People take partial truths like a country adjusting gold reserves and stretch them into sweeping conclusions about global trends. In reality, not every reserve shift is a clean sale, and not every headline signals a systemic shift. Some moves reflect valuation changes, some involve swaps, and others are tactical adjustments. When these distinctions are ignored, analysis turns into exaggeration. The same applies to silver's recent strength. Yes, it has moved aggressively, and yes, supply-demand dynamics show signs of tightness with repeated deficits and declining inventories, but that does not mean a straight-line rally is guaranteed. Silver historically moves in bursts, sharp rallies followed by equally sharp corrections. What is different now is visibility. Silver is no longer a quiet market followed by a niche group. It is back in mainstream discussion. That shift alone changes behavior, bringing in more speculation, more attention, and more volatility. Gold, meanwhile, continues to draw strength from deeper forces. It is not just reacting to headlines but to a gradual shift in how investors and institutions view long-term stability. Confidence in financial systems is not collapsing outright, but it is being slowly questioned, and that subtle erosion is enough to keep gold relevant. The macro backdrop reinforces this trend without simplifying it. Debt levels remain extremely high, deficits continue to expand, and interest costs are becoming a more prominent part of the fiscal equation. Yet at the same time, demand for government bonds has not disappeared. In fact, foreign holdings remain strong, which complicates the popular narrative of rapid de-dollarization. This coexistence of concern and demand is key to understanding the current environment. Investors and institutions are not abandoning the system outright. They are hedging within it. That is where gold thrives, not in total collapse but in partial doubt. It benefits from a world where trust is no longer absolute. Silver adds another dimension because it is not purely monetary. Its industrial role ties it to sectors like energy, electronics, and infrastructure, meaning it responds to both economic growth and investor sentiment. This dual identity is why silver can behave unpredictably, acting as a safe haven asset one moment and a high beta industrial commodity the next. Meanwhile, narratives around safe havens often miss the mark. In real market stress, almost everything can be sold initially as investors seek liquidity. The more relevant question is what gets bought again once stability returns. Gold consistently reappears in that role, reinforcing its long-term position. Silver, while less stable, is increasingly pulled into that orbit. Together, they form a complex system influenced by multiple forces at once: geopolitics, inflation expectations, industrial demand, and investor psychology, all interacting in ways that rarely produce simple, linear outcomes. Another important layer is the growing effort to integrate precious metals into practical financial systems. This includes platforms that allow users to buy, store, and even spend gold, as well as state-level legislation recognizing gold and silver in various forms. These developments are real, but they are often overstated. Legal recognition does not automatically translate into everyday usage, and significant hurdles remain, especially around taxation, regulation, and adoption. Federal tax treatment, for example, still presents challenges that prevent seamless transactional use. So while the direction is notable, the implementation is still early. This is a recurring theme across the entire metals space. Progress is happening, but it is incomplete. The same applies to commercial activity. As interest in metals grows, so does marketing around storage, apps, and investment platforms. These services can be useful, but they require careful evaluation. Ownership structure, fees, jurisdiction, and liquidity all matter far more than promotional language. The key distinction is understanding where analysis ends and sales begin. Many narratives blend the two, making it easy for viewers to confuse engagement tactics with credible insight. At the same time, public interest in metals is rising, but not to the extent often claimed. Ownership remains far from universal, which actually supports the idea that the cycle is not yet fully mature. Markets typically move through stages of awareness, and current conditions suggest we are somewhere between early adopters and broader financial recognition, not at the peak, but no longer at the beginning either. Taking all of this together, the most important takeaway is that precious metals do not require extreme scenarios to perform well. Gold does not need a complete collapse of the financial system, and silver does not need a permanent supply crisis. What they need and what they currently have is an environment of persistent uncertainty. Debt remains high, deficits remain large, policy responses remain flexible, and confidence continues to shift at the margins. This combination creates steady demand for assets that offer diversification and perceived stability. At the same time, rising attention brings increased volatility, especially for silver, which attracts both long-term investors and short-term traders. The result is a market that can move quickly, correct sharply, and still maintain a broader upward bias. The real challenge for participants is not predicting exact price targets but maintaining clarity amid noise. Hype, promotions, and oversimplified narratives can distort perception, making it harder to see what is actually driving the market. The advantage comes from recognizing the underlying conditions rather than reacting to every headline. If the current environment persists characterized by gradual shifts in confidence, ongoing fiscal pressure, and growing interest in alternative assets, then precious metals are likely to remain relevant, not as a guaranteed path to rapid gains, but as a steadily strengthening component of the financial landscape.